A bad day in India is better than a good day in any other economy in the world.
Wow. Do all ventures really require funding?
Every business does not need funding. You really don't need a lot of money to start up. You have to have a growth mindset. There are many businesses which are well run, which are profitable, which have never raised money, and which have had decent outcomes. A founder's mindset shapes strategy. All good businesses are built around pools of distraction. Feedback is the breakfast of champions. As a founder in India, we are spoiled for choice. As an investor in India, we are spoiled for choice. I think there are two ways to build networks. There's a push strategy and there is a pull strategy. The most incredible founders have a very large purpose in life and they're able to transfer that purpose to their teams. I think even in smaller towns now, there is a growing desire and recognition for entrepreneurs and founders.
When is the right time for you to start looking at raising money?
I think there is no right or wrong answer around it, primarily because...
Hey everyone, welcome to this super exciting episode of the ACLR8 Founder Academy. Today's topic is something that a lot of early stage companies face a challenge in: fundraising. It is often said that raising your first round is one of the most difficult aspects early stage founders grapple with, especially if you're a first time founder or you're not from the ecosystem. So today, to demystify all of this, we have Apurva Chamaria. Apurva heads startup and VC at Google in India. He's been in leadership positions in some of India's most iconic companies. He's an esteemed author and he's a super active angel investor. Apurva's investment portfolio is worth 100 plus companies and he's invested in many unicorns and unicorns. And his investments include the companies like Innovate, Stage, BlueSmart, Lucidius, RateGain, Leap Club, Shiros, and many, many more. Right? He's also had 30 plus exits in his last 12 years of investments. So I believe that there is no one better in the ecosystem to help founders understand fundraising, understand how do they raise their first rounds, and really demystify fundraising 101 for early stage companies. So Apurva, super excited to have you here. Welcome to the Founder Academy.
Thank you so much, Karan. I can't believe it. We've known each other for almost 10 years and we're finally sitting down and doing this amazing podcast together and we are building Accelerate together. So very excited about it.
One interesting thing that you mentioned that there's like 100,000 startups in India today, but the mortality is very high, right? So like if I were to start at the beginning, right? And, like when I'm a founder and I'm building a company, right? How important is your mindset while building a company? Right? All of us follow and love Vinod Khosla. He has this very famous analogy. He says that on day zero, when your company is zero revenue, you can either be building a $0 million company or you can be building a $0 billion company. And if your mindset is to build a $0 billion company, right, you are hiring differently, your strategy is different, who you're raising from is very different. So how important do you think is a founder's mindset when they're starting a company, and how big a role does that play in terms of mortality and in terms of helping founders build large brands?
So it's a great question, Karan. So firstly, I wanted to destigmatize any kind of small outcome. I think it's perfectly fine if a founder is building a $1 million company, a $250,000 company, or a Decacon, which is a $10 billion company. It's a personal choice. It's a lifestyle choice. It's a choice you make in a very deliberate, considered manner. Important is to be cognizant that you're making that choice and be happy about that choice. Now, what are the different kinds of mindset? I think the reason why a 0 to 1 million or a 0 to 1 billion mindset is different and is important is a founder's mindset shapes strategy. Initially, you're one person who's a dreamer, who's a doer, who's gone out to change something in the world and create something which has not existed. So when you're making a strategic choice that when you want to build a $1 billion company or a $10 billion company, you will attract the kind of people who want a big outcome. You will attract a different kind of DNA. You will attract people who are alpha, who want to get it done, who are okay to get it wrong but build fast, who are okay with things breaking but want to build big. If you want to build a $1 million company, you would attract people who are more conservative in their approach, who are not okay with things not being perfect, who want a very considerate, deliberate, know-it-all approach before they start building. You will also attract a different set of investors. For $1 million company, maybe you will attract your family, friends, your professors from college. For $1 billion company, you will attract institutional capital. You will attract the largest founders, unicorn founders, who can see that desire and that fire in you to build. Your risk-taking ability is going to be very different. If you're building a small company, you would avoid all risks. There's no reason. You're okay with a 10-20% growth. When you're building a big company and you're not taking risks, that itself will slow you down. The amount of innovation which you will practice when you're building for $1 billion outcome is going to be very high. You would do everything in an agile format. You would decentralize and delegate a lot. For $1 million outcome, you don't need to delegate a lot. Everything can be done in centralized fashion. So your organization culture is going to be very different basis this mindset which you're selecting. You would want to go global if you want to build a $10 billion company, or you would want to go pan-India. For $1 million company, you might be okay just doing a couple of cities. So that's a huge strategic choice.
Got it.
So as they say in Alice in Wonderland, which road should I take? That depends on where do you want to go.
I think it's a super interesting point, and one thing that you mentioned is destigmatizing both the outcomes, right? Like I've been a 2-time founder, right? My last venture was a health and wellness brand, scaled it to almost like a 50 crore revenue with a 30% EBITDA, right? So even that outcome is good, and versus like an outcome where you're building a 1,000 crore company, well funded, right? With an aim to eventually become like a unicorn, right? Even that outcome is good, but eventually the set of investors that you attract and the way you strategize and you build is very different, right?
Very different.
And does it also then beg this question that all ventures don't really require funding, right? So like what do investors look at when they're funding a venture, right? Like eventually are investors also looking at $1 billion outcome, or are investors okay funding companies which can be $5 million, $10 million in outcome as well, right? So like, because there's a lot of talk these days, where founders say that unless they have raised a round, they will not be able to build a large company, right? So I think this question has two parts. One, do all ventures really require funding, right? And if yes, then what are the goals that investors are looking at when they're funding these companies?
I think you're absolutely right, Karan. Every kind of company, every kind of founder does not need funding. In every fashion, my parents, your parents, they've been founders.
Yeah.
They've
India has
running
millions of small and medium businesses, right? Like not all of them are funded.
Absolutely. So I think every business does not need funding, and funding actually could be detrimental to some kinds of businesses because the investors might start driving the founder's agenda, the company's agenda, and lead to growth which is not required. First principle thinking, even cancer is a kind of growth, but it's not the kind of growth which is required. So there are many businesses which are well run, which are profitable, which have never raised money, and which have had decent outcomes. So I think if you want independence, you want to build businesses at your own pace, you want to do it in a conservative fashion, you want to be very deliberate, you're okay with slower sustainable growth, you want to minimize risk, it's perfectly okay to build a bootstrapped business and not raise funding. For a large outcome, funding is often helpful because think of it like you're in a car chase and you open the nitrogen and you get a booster and the car accelerates, leaving others behind at the last. Funding really gives you that additional impetus and the boost to grow the business faster. It's not only the capital. It gets goal congruency between amazing people who are investors, who've seen many businesses, who are well networked, and who are able to then work as your almost like a quasi board of advisors. And their interest and your interests are completely aligned. So it's not only capital, but you suddenly start becoming a part of an ecosystem which helps you succeed. You have many more people wanting for you to succeed other than your friends and family because you're creating a shared outcome for many people. Your opportunity to create a impact also increases. typically most businesses which have not raised capital are relatively smaller. If you've raised capital, your desire to create impact, your ability to create impact millions of households, you've been a founder of a consumer brand. If you had raised a lot of money, maybe 30, 40 lakh households in India would be using it.
Correct.
And that's the difference.
Yeah, yeah.
On your question on when you raise money and if you don't raise money, I think important is to understand if you raise money, what is the expectation of investors from you? I think investors want you to demonstrate massive growth potential. If you're building a $4-5 million company, in most categories, you'll find it very hard to get an exit. I think exception is direct to consumer or a app-based business. So if you're a direct to consumer business and you built a 100 crore business, which is 10-11 million, and you've not burnt a lot of money.
Let's say EBITDA positive.
You're EBITDA positive. Many companies which we are seeing now, which have traditionally not been founded by IIT, IIM founders, are also PAT positive, not only EBITDA positive.
Yeah.
I think you can get a good outcome. You can sell a 100 crore company for 200 to 250 crores.
Very interesting.
If you have shown a good trajectory, your retention rates are high, your reorder rates are high, your cohorts are strong, which is a great outcome. 5-7 years you've put your life in.
Correct.
Yeah.
Yeah, yeah. No, I think super relevant, and like from my personal experience of bootstrapping a brand, right? One thing that I realized is that when we grew Zoe to almost like a 50 crore revenue as well, like we were never very bullish in terms of our hiring, in terms of our goals. Like if I were to hire somebody, I would first think that can I not do this role myself? Right? And eventually, one of the downsides maybe of bootstrapping too long is that you kind of lose that aggression and you like lose that big vision thinking, right? And you want to do everything yourself versus like maybe if you were to raise money, like as you said, have that booster, right? Hire faster, hire smarter people, train them, and then maybe go for a larger outcome, right? And again, both our outcomes are correct, right? Like I'm still very happy that I built Zoe into a very profitable company, but again, it's the path that you decide to take.
Yeah, absolutely, completely agree with you.
Amazing. And like are there like you mentioned SaaS, you mentioned D2C, right? So are there any sectors which are preferred for investors, which generally get more funding? So if I'm an early stage founder, right, should I look at certain sectors to build in which are generally preferable in terms of investors? And if yes, then like how does one actually understand which sectors to build in? Like, obviously you can look at where your strengths are, right? But do I also like study large revenue pools, profit pools of listed companies to understand sectors? Or how do I go about thinking on what areas to build in, basis the fact that these are the sectors which are likely to get funded in India in the next 5 to 10 years?
So I'll separate the question into two parts. The first question is, how do you identify what to build around?
Yeah.
And the second is, what are investors funding?
Yeah.
I think when you're thinking about the first question, what to build around, there is a data-backed approach where you look at what are the markets, how competitive those markets are, what are the profit pools. You talk to consumers or customers to understand what are the pools of dissatisfaction around. All good businesses are built around pools of distraction, pools of dissonance, pools of dissatisfaction. The larger the pool of dissatisfaction, the larger the outcome you'll get. So as founders, it's not only about the existing market size, because existing market size, existing profit pool might show you that the market doesn't exist. Like when Steve Jobs and Apple launched the touchscreen phone, there was no market for touchscreen phones. So I think that is one of the inputs. But you should also look at what could the market be. What is the dissatisfaction, discontent in the people, and think about that. Third very important thing is, do you have an affinity to the sector? For you, I think you build Zoe and you're a content creator, you're an investor, you have a natural affinity to DTC. You would make a great DTC founder. But maybe tomorrow, if you decide to do something in space tech, which
Yeah.
requires deep technical competency, understanding of regulatory issues, ability to manage the regulators, you might possibly find it hard.
Yeah.
You might do well, but you might not enjoy the process.
Yeah.
Life is very short. I think as founders and investors, we should build what we enjoy building. It's an incredibly hard journey. Imagine you've set out on a very hard journey
Yeah.
and you're not enjoying the journey.
Yeah.
It's better not to leave home.
Yeah.
So when you're thinking about building, look at it with data,
Yeah.
but also look at it with heart.
Yeah.
And at times, the heart is what is going to help you survive in a tough day.
Amazing. No, I think super relevant. And, like one very interesting point that you mentioned, pools of dissatisfaction, right? So like almost look at large industries, but look at customer dissatisfaction rate, right? Or if there's low retention, right? So for example, I think one industry that comes to mind is ride hailing, right? Like how like Uber and Ola in India actually revolutionized it, and now you cannot even imagine hiring a cab just without an Uber or an Ola, right? So is there like a hack there, or again, because how can founders actually look at identifying industries which have high pools of dissatisfaction, right? And I'm asking this because founders, again, you mentioned lead by the heart. They lead by the heart. They just want to do something. They want to build something very large, right? Since I was, I think, 12 or 13, right, I knew I wanted to be a founder, right? And
Wow.
I founded two businesses. One was successful exit, one was a profitable company. Now I'm doing Accelerate with you, helping early stage companies. So I always knew I was a founder. So sometimes as founders, we lead by the heart, or we we want to do something. But if we were to put in a little more research on what we need to build in, right, and solve the why rather than the need for building, right, it would be a larger outcome, right? So any other examples that maybe you can share in terms of helping founders identify those large pools of distraction? How do they go about studying these large opportunities before starting out?
So, I'm going to share some more insights around it. So, India is right now a $2.3 trillion economy. By all indicators, in the next 4-5 years, maybe 7 years, we are going to be a $5 trillion economy.
Yeah.
We are right now the 5th largest economy globally. Hopefully, we're going to be the 3rd largest when we get to 5 trillion. It's also an economy which is a bellwether in the global economic map. We are going to grow at 6.3, 6.5% for the near foreseeable future, for 5 years, 7 years. I was hosting somebody who was visiting India from Mountain View, US, and I was telling them that, in India this year there have been layoffs and startup funding has dried. And that person made a very interesting observation. He said a bad day in India is better than a good day in any other economy in the world.
Wow.
As a builder and as an operator. And I think that's a very telling insight. As a founder, if you're thinking about what to build, in India there are large opportunities in every sector. In lending, in space tech, in insurance tech, in delivery, in consumer brands. As per capita income is going to go up.
Yeah.
Right now we are at about $1,800-$1,900. $1,800 is the space where most consumers use the income to subsist.
Yeah.
The moment you start getting into that $4,500, $5,000 per
Yeah.
capita income range, you're going to start spending on discretionary activities.
Yeah.
You're going to start investing.
Yeah.
You're going to start desiring for a premium lifestyle.
Yeah.
Your aspiration is going to go up.
Yeah.
So, as a founder in India, we are spoiled for choice. As an investor in India, we are spoiled for choice. I think you can be strategic. You can look at data. You can look at market share data. You can look at Play Store data. Hack to your question. Look at any category. Look at podcasting.
Yeah.
Look at all the podcasting apps on Google Play Store.
Yeah.
Look at their ratings.
Yeah.
And read all the consumer reviews.
Yeah.
The moment you study 30 apps in the consumer reviews,
Yeah.
it will tell you what is the pool of dissatisfaction.
Yeah.
And you can build around it.
Yeah. Yeah.
That gives you an idea.
Yeah.
Test that idea.
Yeah.
Build a proto.
Yeah.
test it,
Yeah.
and build on it.
Yeah. No, I think very, very smart answer. And, like when I started Zoe, like that's what we did as well, right? So we went on Amazon and we looked at, health and wellness as a category, right? Because we wanted to build something which adds value to people's lives. So we went on health and wellness. We looked at the reviews of brands, and we looked at, so from the reviews, we could count, from the recency of reviews, you can count how many orders are they getting on a daily basis. And from the negative or positive reviews, you could also see how many how successful a brand is, or how good their satisfaction rate is, right? So if the brand is getting good orders and but the reviews are negative, that becomes a space for you to then kind of build towards.
Absolutely.
Right? So then essentially, like, there are a lot of these public platforms like the Play Store data, or maybe your Google ratings, or Facebook ratings, or Amazon ratings, right? So actually leverage on those to kind of find those large pools of dissatisfaction.
Absolutely. And I think be out in the open.
Yeah.
As a founder, it is, if you want to be a, what I call a air-conditioned office founder, it's very hard to build. Go out, travel, meet people.
Yeah.
One of my portfolio companies is Blue Smart.
Interesting.
I think it was obvious to everybody that the two large players in India, their fleet had completely deteriorated.
Yeah.
The cabs would not show up.
Yeah.
At one time, people said, ride hailing, cab sharing, cab hailing as a market is gone.
Yeah.
You have Uber, you have Ola.
Yeah.
Both have raised a lot of capital.
It's a duopoly. Yeah.
It's a duopoly. There is nobody who will be able to create a market around it.
Yeah.
All of us, the problem was staring at us, right?
Yeah.
Cabs were dirty. They were not showing up on time.
Experience was
bad. Drivers were cancelling. And Blue Smart came with a completely EV fleet.
Yeah.
It came with cars which are clean. It came with drivers who would not cancel.
Yeah.
And they've created a market.
Yeah. Yeah.
So I think when you walk out of your house in India, you should just see opportunities.
Very interesting. No, I think really amazing insight. And I think one thing that you mentioned is, like an air-conditioned founder, right? Versus somebody who would hustle, right? So what are some traits of successful founders, that you have seen across your portfolio companies, right? Like 100+ companies, many unicorns in your portfolio, right? You've been investing for 12 years, right? So are there 5-6 traits that you have seen commonly across founders which have kind of resurfaced again and again in businesses which have become large?
It's a fabulous question. If I try to do trend spotting across the 100+ companies where I'm an investor, also anti-portfolio companies where I've not invested and they've gone on to do very well.
Yeah.
And, other successful founders whom I have not met or just seen from far. I think some of the things which are incredible and which sort of pop out at you when you see an incredible founder is a larger purpose and vision. Yesterday I was at Indian Mobile Congress with Yashish Dhaya. And Yashish gave me a very interesting story. He said, Apur, when we started Policy Bazaar, we felt that in India, a lot of people don't even understand the benefit of insurance.
Yeah.
And the insurance which were being sold were all financial products. But actually, when you die or you go through a health ailment, the only one thing which helps you is insurance.
Yeah.
And a lot of people find Policy Bazaar callers very pesky because Policy Bazaar would keep calling. And Yashish said something very interesting. He said, Apurva, our target audience is people earning more than 5 lakhs and less than maybe 50 lakhs. You have to call them. You have to consistently remind them.
Yeah.
And we told all the people in our call center, contact center setup that tum masiha ho, tum farishte ho.
Yeah.
If you keep calling people and they end up buying a policy, you are going to help somebody in a very, very bad day of their life. Versus you telling someone that your daily KPI is just generating orders, revenues.
Yeah.
I think the most incredible founders have a very large purpose in life and they're able to transfer that purpose to their teams. Example from my portfolio are Supriya Paul and Shobit Banga from Josh Talks. When they started, they felt that...
And this was, I think, a few years ago, right?
Like, pre-COVID.
Yeah.
So when they started, they felt that India does not need more of, Western content, which does not connect with Indians.
Yeah.
if they can ignite Josh
Yeah.
in a billion Indians,
Yeah.
India would be a superpower.
Yeah.
And that's the DNA of their whole company, of all the people they hire. And they're just passionate about discovering the best stories, sharing it with Indians,
Yeah. Yeah.
inspiring them, igniting that spark.
Yeah.
And अगर वो कर पाते हैं तो आप जोश जगा सकते हैं.
Yeah.
So that's an incredible trait. I wanted to talk about founder resilience. All founders, or all for that matter, even non-founders, will go through ups and downs in life. I think as a founder, when you go through a down,
Yeah.
you're also responsible for people who are working for you.
Yeah.
You're responsible if you've raised money to investors. It is very, very important to be resilient.
Yeah.
Mentally resilient, physically resilient. So if you're not taking care of your health,
Yeah.
if you're not taking care of your mental well-being, and we often don't talk about this thing in India,
Yeah.
but when you're going through a lonely cycle and you feel you're a failure and you're unable to raise money,
Yeah.
you're not sure how will you pay salaries,
Yeah.
you're stuck in a legal issue,
Yeah.
you have to demonstrate unreasonable, unending resilience, unending energy.
Yeah.
Even in a bad day, you have to walk up with a smile and say, today is the day.
Yeah.
You have to be an optimist. You have
Yeah.
to say, next hour will be a better hour.
Yeah.
And I've seen that incredible trait in some of the founders. Give you an example of Vinay, Praveen, and Shashank from Wittyfeed, which is now called Stage.
Yeah.
I remember they were doing very well. At times, they were the second largest viral marketing content site in the world behind BuzzFeed.
Yeah.
And they got slapped with a massive lawsuit from a large internet giant. They fought it. They were absolutely in the clear. But at one time, just the legal fees drove them out of business. What do you do when you've built a very large business, which has come crashing down, and you've had to sell your house, you've had to sell your wife's jewelry,
Yeah.
you've had mental health challenges? What do? You start another business.
Yeah. You fight through the day and
You fight through the day.
Yeah.
They started another business, and recently, Bloom invested in them
yeah.
at a 300 crore valuation.
Popular Shark Tank story as well.
Popular Shark Tank story, right? Mental resilience is very important. Good times never last,
Yeah.
but the amazing thing is bad times also never last.
Yeah. Yeah.
Good founders last.
Yeah. Have that long-term view and confidence in your own ability.
I would say you have to be an insane optimist.
Yeah.
Everything has to look like it's going to work,
Yeah.
and it's going to become a self-fulfilling prophecy.
Yeah. Yeah.
It does not mean you can be delusional,
Yeah.
but I think you have to have a very high degree of self-confidence, a
Yeah.
very thick skin,
Yeah. Yeah.
and you have to enjoy the process.
Yeah. I think one very interesting point that you mentioned, right, like is taking care of your mental and physical well-being as well, along with your business, right? And I think that's not enough said in India, right? And like that's when we are talking also, that's one of the reasons that community was such a central pillar at Accelerate as well,
Yes.
right? Being a founder is incredibly hard, right? Sometimes you would feel like the loneliest person in the world because you have to go back to your employees, you have to be that eternal optimist while you are dealing with so many challenges, on your own, right? So having that community of founders who can understand, who can give you that confidence, who can, reaffirm that this is a 10-year plan, good days never last, bad days never last, who can maybe calm you down when you get very excited on a win, and also calm you down when you're very low, right? So I think that is very, very important. And and again,
I
founders,
think a key tenet of Accelerate should be just getting founders, successful founders, to share their bad days.
yeah,
Because you need that ammunition to understand you're not the first person who's going through it.
yeah,
And you're also not the last person.
yeah,
And most important thing for a founder to understand is this too shall pass.
yeah. Very, very interesting. And again, on founders, right? So I meet a lot of founders. I think you meet 3-4 founders on a daily basis for the last 10 years, right? Which is like an amazing number, right? And we meet a lot of founders, who are first-time founders, right? Who are founders from tier 2, tier 3 cities, who might just still be in college and starting a company, right? I recently invested in a 17-year-old guy, right, who's building something out of college, right? So does being from an Ivy League increase your chances of fundraise? versus if you're not, and if you have, let's say, don't have a lot of years of experience, you're not from that ecosystem. So does that happen? And if yes, like what are some things that founders who are, let's say, not from a Delhi, Bombay, Bangalore, like who are not from an Ivy League college but have that passion, have that unique insight on the industry, what are some of the things that they can do, to become a part of the ecosystem and also reach successfully?
Fabulous question. I think, to be very honest and maybe even politically incorrect, I think if you're from a good college like IIT, IIM kind of a background, it is a leading indicator of you've already worked hard. You wouldn't have cracked the interview. You worked in a good company after that. It already shows certain aspects of character which are backed by data. It gives you a network of other successful people, your seniors, your juniors, your batchmates, who are either investors or founders you can tap into. There is no taking away from that.
Yeah.
And that's not going to change. And it's perfectly okay. You've worked hard to get into a good college.
Yeah.
You should get some benefit for that. But I think if you don't have that, you should not lose heart. You should be optimistic. Your strength is going to be you're not following any template. You're looking at opportunities and problems from a fresh perspective.
Yeah.
You are going to create a network which is across colleges, across institutions.
Yeah.
Your desire to succeed might be far higher than someone who's already accomplished so much.
Yeah.
And I think that's the mojo which founders from tier 2 towns, people who don't speak English well, people who have not gone to IIT, IIM should tap into.
Yeah.
And they should use that to fuel their desire to really, really succeed big.
Yeah.
And I also think that the converse also holds true. If you've gone to a good college, if you have a nice degree, you've worked in a top MNC, you might also have a sense of entitlement. And that entitlement mentality could take you away from the ground and make you less considerate, less closer to the customer. I think when you don't have things, you learn how to build things frugally. You learn how to build things in an innovative fashion. And you could also be a very unique combination where you've come from a small town. Maybe your English isn't great, but you've worked very hard and then made it to a top college, which is incredible. So I would say it's an equal opportunity for everyone. Nobody is going to hand it over to you free. You're going to earn your right. You're going to earn the right to have amazing people, investors on your cap table. When you are pitching your vision, hiring the first 10 employees is incredibly hard. Because you're a nobody.
Correct.
You're going to have to earn the right by selling your vision and getting those 10 people to believe in you. No amount of degree can prepare you for that. So when you step out in the world and you start building, it is day zero.
For everyone.
For everyone, and that's why day zero is a huge part of the philosophy at Accelerator as well. We want all founders to believe in a mindset that every day is day zero. And approach it with fresh eyes, fresh enthusiasm.
Got it. Amazing. I think, very, very relevant. And, just, for fun, right? Like what percentage of your portfolio would be companies which are, let's say, Ivy League founders versus, like non-Ivy League founders or, like tier 1 city founders?
So I've been investing since 2012. And many of my companies are from founders who did not go to IIT, IIM, ISB, who did not go to Ivy League. And it is not that I consciously went out seeking for them. I was fortunate enough to meet founders who were incredible, who came from smaller towns, Jaipur, Pune, Indore, Lucknow, Meerut, and who had very big dreams, who were amazing storytellers, who could convince me to back them. And many of them have become fantastic friends, learned a lot with them. So I would say 30-35% of my companies are,
Wow. That's an amazing number.
Interestingly, I think I also have one of the largest portfolio of women-founded companies.
Interesting.
So one of the disturbing stats in India is less than 6% of women founders go on to raise money, and less than 1% partners in women in VC funds are women. So, and I feel, it is incredible. As women, you're already trained to be multitaskers.
Yeah.
You have a very high EQ.
Yeah.
You have a natural ability to build things,
Yeah.
maintain the equilibrium in the house,
Yeah.
maintain it outside.
Yeah. You're a fighter.
You're a fighter.
Yeah.
You've never got it easy on a table.
Yeah.
So, and I think the women founders in my portfolio are doing incredible.
Very, very, very interesting.
Yeah.
I think super insight and super inspiring as well. So, Apurv, like, on today's topic, like one of the questions that I get from a lot of early stage companies is, when they're raising their first round, right? Like, when should they start looking at raising money, right? And, should they, like, at least develop a product? Should they start raising at an idea stage, right? Should they get a few customers, right? And, and this is a problem which is across stages, because what happens is that sometimes founders, let's say, would get a certain revenue and then they would approach investors and they say we would want more traction, versus you would see founders who've also raised money at an idea stage as well, just by presenting a deck, right? So so when should you start thinking about raising, right? Because today raising money has almost been akin to starting a business. If you're not able to raise money, you'll not be able to start up, which is not correct. Like, there's very successful bootstrap founders as well, right? So when should you start? When is the right time for you to start looking at raising money?
I think there is no right or wrong answer around it, primarily because...
And does it vary across sectors as well?
Yeah, that's a great question. I think there's no right or wrong around it. If you come from a well-to-do background, or you've worked for some years and you've saved money, or you found a customer who's willing to take a bet on you and give you an advance to
Wow.
or your services, you can start a business without raising money.
Yeah.
So at times what people also do is, and today it's very easy, you can build a prototype on Figma.
Yeah.
You can use Canva to create decks.
Yeah.
You really don't need, you can register a domain name for 3,000-4,000 rupees.
Yeah.
You really don't need a lot of money to start up. So wherever you are across India, I think the cost of starting up has really, really gone down. So it's always a good idea, if you've done something, if you have a nice deck, you can articulate a story, you have a financial plan, you have a MVP, you have paying customers. The more mature your business is, the more convincing you are. That said, there are exceptions to this rule. If you're a second-time founder, you can go out and raise money basis your credibility, basis the mistakes you have made, basis your articulation of how you are more well-placed to succeed this time, even without having a deck at times. And notable examples of founders who've had big exits and who've raised money second time very fast, because they're creating something very big and they needed capital. Smallest form of business is being a creator, individual, solopreneur. And you don't need money for that. If you're good at speaking, if you're good at photography, you can just go ahead and start a business before even raising. So there's no right or wrong answer. The way you should think about your business is idea identification, creating the MVP, finding product market fit, getting early customers, getting repeat customers, building a world-class team, creating opportunities to expand by upselling, cross-selling, and then creating opportunities to exit. So that's the whole cycle. You can raise money at any part of the cycle.
Or maybe at all.
Or maybe never. Maybe never. I always think, a customer's money is the best kind of funding you can get. Because you've really earned it. They're not going to give it to you easy.
No, and I think that's true for one of my portfolio companies as well. They're into mobility, right? And they've built a very loved customer brand, right? So like they just sent out this email that we're looking to their customers that we're looking to raise our first round, and I think within 3 hours they were able to get commitments worth 10 crores.
Wow.
So and that's the kind of brand they've built, and so I think what you said, right? Like, so I like starting up is not very difficult in terms of money, right? So if you have that unique perspective, if you have that idea, go out, build, get your first few customers, get that feedback from the market, build your deck, and when you have that conviction that okay, now at least I'm getting some repeat orders if I'm building a consumer brand, right? I'm starting to generate some revenue, and this is the large market that I'm trying to address. Then maybe you can start
Absolutely.
approaching investors.
Absolutely.
And then
I would say if you don't feel you're finding product market fit,
yeah,
don't raise additional capital.
yeah,
Continuously work on it and don't scale until unless you feel you found product market fit.
yeah, yeah. And I think product market fit is such an important, and I think a lot of time it's misused as well, right? So we have actually doing sessions on the Founder Academy, multiple sessions with unicorn founders just on product market fit. How do you understand product market fit across different categories and industries, and how do you know, okay, now this is the right time for me to kind of raise as well?
I think you should raise when you really know that raise is going to give you disproportionate returns. For every extra dollar you spend, you're going to get $10 back.
Yeah.
If you don't have a sense, a data-oriented sense of that disproportionately, which that capital allocation will lead to, then it is better to be deliberate,
Yeah.
find out that, and then only raise capital.
Yeah. Because raising money also takes a lot of time
Takes
and
a lot of time.
effort, right? Like it could be like 4-5 months of one founder's effort.
Absolutely.
Yeah.
Absolutely. And the effort doesn't stop there. The
Yeah.
moment you get new investors, you're going to get divergent thoughts.
Yeah.
You're going to have to keep them updated. You're
Yeah.
going to have to respond to their questions.
Yeah.
So the post-fundraising journey also takes a lot of effort.
Yeah. And again on that, so if I'm an early stage founder, how much should I raise? Like, is there, like a benchmark? I mean, like I would have seen seed rounds at 500K, 1 million, 10 million, 15 million, 40 million as well, dollars, right? And, so how much should I raise? How much should I value my company at initially, right? And then who should I raise from, right? So should I look at approaching VC? Should I look at approaching micro VC? Should I look at approaching angel investors, right? So if you can throw some light, right? Because, like for example, when I was a young founder and I started Zoe, right? I did not think of it this strategically, right? I just thought ki I'm starting a business, I need to raise money. I went on LinkedIn, searched the word investor, 100 people came in, I dropped a cold DM to everyone, and maybe that's not the most effective thing to do. I didn't have those relationships and none of them replied, and I was not able to raise money. And then I felt dejected that, okay, this doesn't work. Maybe I'm not from that background. I'll never be able to raise money, right? So I think 3 questions: how much to raise, how much to value your company at, and then who to raise from. Like, and like, are there specific people across sectors or industries that you should look at raising your initial rounds when you're building in a particular category?
I think it totally again depends on what's your background as a founder. If you're a second-time founder, you can reach out to a stellar VC.
Yeah.
If you have a great idea, you can directly raise from them. If you've had a large exit, maybe you can even bootstrap it to some extent before raising. If you're a first-time founder and you've never run a company and you don't have the network, you're better off raising from friends and family to start with. You can also find people who've built very large businesses in adjacent or a similar category and go to them.
Yeah.
For example, if you're building a lending business,
Yeah.
you can reach out to somebody else who's built an insurtech business,
Yeah.
who's built a lending business,
Yeah.
and you're doing it differently, and
Yeah.
you can raise capital from them.
Yeah.
So I would say there are strategic investors. Strategic investors could be companies or individuals, founders who see a sense in backing you.
Yeah.
There are angel investors who are in to learn, who are in to make money. You can raise from them. There's some fantastic platforms in India which are angel networks where you can go and raise money. There are early stage and seed stage VCs. You can raise money from them who back you when you're very early on in your journey. There are companies which run founder fellowships. There are accelerators which will help you raise money.
Yeah.
If you're a first time or a second time founder and you're looking at identifying pools of capital and you don't know where to go, you could join a program like Accelerate,
Yeah.
get accelerated, and on the demo day raise money
Yeah.
by doing an outstanding job in the last 3 months.
Yeah.
So those are the people you can raise from.
Yeah.
How much to dilute is a great question. I think the first ever round should not be more than 11-12% dilution.
Interesting.
Because if you dilute more than that, by the time you reach Series B, 6, C, between you and your co-founders, you would hold less than 20-30%, which is never a good idea.
Yeah.
You should always raise enough money to give you 18 to 24 months of runway. And 18 to 24 months is very important because, like you said, Karan, fundraising takes time.
Yeah.
And you don't want to be always
Doing this
fundraising.
all the time. Yeah.
Yeah, because that takes away focus from building the company culture, connecting with customers,
Yeah.
finding out what's happening in the market,
Yeah.
building the product, building the service,
Yeah.
institutionalizing and making the processes replicable.
Yeah.
So a good idea is to always raise enough money which will last you 18, 24 months.
Yeah.
There are exceptions. If your competitors are raising very fast and you feel you will be thrown outside the market, you need to raise fast. So there's no hard and fast rule.
Yeah.
There are companies which have raised and not raised for 10 years also. So because they found product market fit, they've been profitable, and they've never felt the need to raise. And then they have raised because they want to do inorganic growth, M&A, or they want to get in strategics who are going to help
Very
them.
typical in SaaS companies.
Very typical in SaaS companies. So that's happened.
Yeah.
I would say when you're thinking about how to value your company, it's going to depend on which sector do you operate in. SaaS valuations are very different from DTC valuations.
Interesting.
Fintech valuations are very different from space tech valuations and deep tech valuations. You should think about what geography you're serving. If you're a SaaS company serving in India, selling to customers in India versus selling to customers in US, the valuations will vary because US is going to be a higher profit pool. The average order value is going to be higher. It's also a mature market. So if you're able to demonstrate you're building in a mature SaaS market, your valuation is going to be higher. It is going to depend on whether you're raising in a bull cycle or a bear cycle. Right now, it's a bear cycle in India. So the valuations have corrected noticeably.
And maybe you're getting more resilient founders.
You're getting more resilient founders. So there is a... it's also going to depend on what is your discounted cash flow statement showing, what are the industry comparables of companies which are similar to you and how much have they raised, at what round.
Got it.
And I think finally a lot will boil down to what is your negotiating technique, how well are you able to articulate what is the valuation you're seeking and why do you feel that valuable is reasonable. And we like to think that all investing is rational, but a lot of it is also FOMO driven, emotional. So I think if you're as a founder able to create FOMO, you're obviously going to get a higher valuation.
Very interesting. And I think like one thing that you mentioned is that, like this is going to take a lot of your time, right? So according to you, like what's the ideal founding team structure, right? Like, is it, I mean, like there's a lot of debate around being a solo founder versus having 2-3 co-founders, right? So do you think that almost like it's one person's role in the founding team to just raise and then reach out to more investors and give them updates and then maybe raise again and plan for the next round, and the other team members are maybe focusing more on executing the business and growing the business? So should I think of it like that, or I mean, like even if I'm a solo founder, I can do both
I think if
together?
you're building a business which requires a lot of capital, it has to be one person's job to be very good at raising capital, to being able to sell the vision, explain the P&L, explain the right to win. And fundraising in that kind of a setup is a full-time job. If you're not building a business which requires a lot of capital, where you'll be raising regularly, then you could have founders focused on the product and tech or the service. You could have founders focused on ops. You could also have founders who are very good in go-to-market and route to market. Many examples, right? Off business is a great example. 5 founders, everybody's skill is different, and they're all focused on what they're good at.
Closer at 15,000 crore revenue.
Exactly. And profitable, 938 crores.
Amazing.
As declared last.
So,
being a solo founder is incredibly tough, and personally, I would not recommend it to people. None of us are perfect. Even a Batman needed a Robin. So it's good to work with friends, work with co-founders, work with people with complementary skills, and I think that's really important.
Got it. Got it. I think one thing that you mentioned is, expanding your network and obviously reaching out to more people, right? So, uh, like while if you're from the ecosystem, maybe it's easier, right? If you have an alumni group, you can reach out to them. But if you're not from that ecosystem, right? What are some tips that you would recommend to founders to help build that network, right? Like if we are in Delhi, Bombay, Bangalore, the ecosystems are more evolved. But like if you go to a Lucknow, a Siliguri,
Yeah.
an Ahmedabad, right, where the ecosystems are let's say not that evolved, then how can I go about building my network, build those very very valuable relationships, that can help me grow.
I think there are two ways to build networks. There's a push strategy and there is a pull strategy. Pull strategy is create your personal brand. Write on LinkedIn, become an influencer, become a content creator, do podcasts,
Yeah.
comment on other people's work
Yeah.
in a very thoughtful, deliberate manner, host a show, invite guests,
Yeah.
volunteer.
Yeah.
When you start creating a brand,
Yeah.
a lot of network comes to you.
Yeah.
That's a pull strategy. Push strategy is join organizations like TIE, join angel networks, reach out to people,
Yeah.
offer to help, uh, contribute,
Yeah.
volunteer,
Yeah.
uh, join online webinars and ask smart questions to the speakers,
Yeah.
go at industry trade shows.
Yeah.
I think even in smaller towns now, there is a growing desire and recognition for entrepreneurs and founders. You also have a lot of investors coming from tier 2. So find out who are the people who are investing or building in your city,
Yeah.
even if it's a smaller city or a village.
Yeah.
Go and meet, ask for mentorship.
Yeah.
So today I think it is, you can build a global network
Yeah.
without even leaving your village.
Very interesting. And I think, like at least what I've seen in the startup community in India is that people are very supportive and people are very open. So if you write to a unicorn founder as well on LinkedIn, right, or if you write a very thoughtful email to them, right, there's a very high chance that they will actually reply and they will give you some time, to guide you, right? So sometimes it's just about being there, asking the right questions. Like I've seen founders, and sometimes they're very resistant on writing on LinkedIn or even communicating to the world what they're doing. They're like in stealth, right? So maybe it's also important to come out of stealth and be actually more communicative. Share on those platforms what you're building,
Yeah.
right? Create content, right, and reach out to more people for help. And when you ask for help, you actually get help as well.
You mentioned a very interesting point. I think any founder who's not sharing what they are building and doing it in a stealth mode is losing out on a great opportunity. I think when you share, you start holding yourself responsible for achieving what you have shared.
Yeah.
Second, if it is so easy that you shared with someone
Yeah.
that I'm building this and you think they'll copy it,
Yeah.
the idea itself is not worth building on.
Yeah. There's no unique ideas.
Exactly,
Yeah.
exactly. And I think it's the execution which will take the gig. So please share often, share successes,
Yeah.
share weaknesses,
Yeah.
share challenges,
Yeah.
and build very transparently and build in the open.
Yeah. Yeah. Understood. Very relevant.
And exception being if you're building something which has a IP around it,
Yeah.
yeah, or very detailed financials, yeah, or your customer data or your own PII,
Yeah. Got it. And I think my next question is around building a great pitch deck, right, and building a great brand story, right? So so like as angel investors, right, we are a lot of times we are in a default no mode, right? Because let's say I would be meeting 100 of companies every month. I may invest in one of them, right? So a lot of times you are in a no mode where you're saying no to a lot of people, and founders also might feel bad sometimes because they're obviously pouring their life and soul into it, right? So how as a founder I build that perfect pitch and that elevator pitch that gets everyone excited and can communicate my vision, right? So like what are the 4 or 5 elements to a perfect pitch that you would say any founder needs to have, and then what are some of the elements that needs to be there in a pitch deck as well, like in a more detailed format?
So let me answer the elevator pitch question first. If you're reaching out to investors, whether angels or VCs, we are in the business of meeting lots of founders every day. We are in the business of context switching. we're in the business of evaluating fast, because that's what early stage investing is about. A very good idea is to, and the way I frame this is, tell me something which nobody ever has told me. Tell me something in a fashion which nobody ever has told me. Make it memorable, make it large, and inspire me with your energy. If your energy is low, your story is weak, and you're telling me something which I've already heard 5 times, I'm more likely to lose interest. That energy transfer is very important in your elevator pitch. Now, if there is a larger pitch, some of the things you should look at is articulate the problem statement very sharply, articulate the solution very sharply, articulate your business model very sharply behind the solution, articulate the traction with metrics which investors are familiar with. Talk about why is this the best team, or why are you the best founder to build this solution. Give reasons to believe. Share your financial projections. Share details around customer cohorts. Share details around who your collaborators, partners, and potential exit outcomes are. When you share all these, end it with how will you use the funds, and also talk about how would you like to work with investors. How would you like the investors to help you? That makes a very comprehensive 360-degree pitch.
I think that's super. That's such a great framework, to think about it, right? Because sometimes things might not turn out the way you have projected it, but at least when you put these out in a deck and in a pitch, you give confidence to the other investor that you actually thought through a lot of these, right? So again, like coming back to Vinod Khosla, I love his quotes, and one of the things he says is that, let's say, building a $1 billion company is like climbing Mount Everest, right? But you don't climb Mount Everest on a straight line, right? Like you go to base camp, and then you rest there, you pivot, you go to the next base camp, and eventually in your journey you pivot and you change strategy, and eventually you reach Mount Everest, right? So at least you should have that larger vision, which should get communicated in the deck. You can have a thought process around what are the steps I will take, how I will have, what will be my strategy. You can be flexible that it will change as it goes, but at least it gives confidence to the investor that I am thinking about solving this problem in this way. Tomorrow the dynamics might change. I might, pivot, right? And it gives them confidence that this is how I'm going to utilize the money to build further.
By the way, a lot of great pitch decks, whether it's the pitch deck for Uber or Airbnb, are freely available on internet.
We've also listed them on the Accelerate website.
Excellent. I think do visit the Accelerate website. You will have a lot of founder tips, tools, frameworks which you can use, which is going to shorten your cycle to raise funds.
Very interesting. And what's the success rate of any pitch, right? Like when you're pitching to investors, sometimes you don't get a yes, and you get demoralized. So across your 100+ investments, like you see so many companies on a day-to-day basis, right? Is there a particular percentage that you see that if I have to raise money from 5 angels, I need to at least reach out to 100? Like, is there a standard number, which founders can?
I think there's no standard number, unfortunately. Even some of the biggest companies which exist today, which have listed, at times in India have faced 76, 80 rejections.
Wow.
Yeah. So, and at times you're so lucky that in 2-3 meetings you're able to raise a round, and the round becomes very competitive and everybody's chasing you. Both of those are fine. And if you happen to be in a market where you are unable to raise and it's taking time, don't lose hope. The next meeting could be the one which turns the corner. Got
it. And how does a founder understand when it's a no, right? Because so as investors also, we get so many decks on a daily basis. Sometimes you're not able to give more constructive or real feedback to founders, and sometimes they also feel ghosted, right? Like they put in so much time and energy, but they did not get a reply, right? So and everybody's trying to be supportive, but sometimes you don't hear back, right? So when does a founder know it's a no, and they should kind of move on? And like are there any tips on that front?
So I think you have to learn to distinguish between a hard no and a soft no. A soft no is a maybe, and it just means that, hey, I liked you, but there are parts of the business which either I'm unclear about or I need more information. And that's where you have to learn as a founder to read body language, follow up, ask probing questions, get feedback, and go back with a very thoughtful, calibrated approach. At times, the soft no is also right. Hey, I would like to know more about, or I would like to track you as a company. Right now, you're not at a stage where my fund invests. You're early or you're late.
Yeah.
So when approaching investors, you have to understand if the investor is investing in that sector.
Yeah.
You have to understand if that investor is investing in that stage.
Yeah.
You have to understand if the investor already has a company in their portfolio doing the same thing. Most investors avoid investing in competing brands in the same category.
So that research is very important before reaching out to those investors as well.
You have to have a very thoughtful, calibrated, considered approach. Spray and pray never works.
Yeah.
Your outreach mails have to be very customized and personalized versus the standard email which is going to everybody.
Yeah, yeah.
And I think if you can get a warm introduction,
Yeah.
a warm introduction has a far higher chances of conversion, whether it's meeting or a investment round, than a cold introduction.
Interesting. Interesting.
If you get introduced to me through a company, a portfolio founder, I'm obviously going to respond in a more enthusiastic fashion. And
How much of your deal flow is through portfolio founders versus first time founders reaching out to you directly?
I think deal flow comes from both portfolio founders and people whom I don't know. A lot of my portfolio has been built around recommendations from portfolio founders. So deal flow comes from all around, but eventually a lot of investments in my portfolio are from people whom I've already invested in. They are recommending a founder, somebody's exited their team and is building something. I'll give you an example. I invested in Hyped. Hyped founder is Aishwarya. Aishwarya used to work at Innovate. He was the chief growth officer, and I was one of the early investors in Innovate. So I think it becomes a motion where you start meeting operators who are working in your portfolio companies or are being recommended by your portfolio founders.
Got it.
That doesn't mean that if we don't know the people, there isn't an opportunity for us to engage, learn more about them, build conviction.
Got it. And how, as a founder, can I close the deal faster, right? So I know multiple founders, who would actually, when they're meeting investors, actually carry their term sheet along in every meeting, and almost like if a founder investor is interested, get them to sign it right on the spot, right? Or how do, what are some ways in which founders can actually close a deal faster? Is it okay to follow up with other investors, right? Is it okay to ask for next steps? And because you have to ask, right? If you don't, and if it's just an open-ended meeting, maybe it never kind of really
Absolutely
results.
I think you have to be very sharp. You have to have clear communication. You have to define the meeting objective. So imagine you're going for a first meeting, whether it's online or in person. You have to say, hey, today we are going to educate you about our business, tell you about ourselves. And at the end of the meeting, we are going to spend 10 minutes asking you about what did you feel about the conversation. And we are going to set up a follow-up time. A very good idea is to not exit any meeting without a scheduled follow-up time.
Interesting.
And taking out your phone and sending the calendar invite and blocking calendars right then. At times, the person might not be sure, might not commit time. Then a good idea is to ask them, hey, is it okay if I come back in 3 days, 4 days? It's also a very good idea to share with the investor that you're talking to other companies, other investors, and at what stage are you? The investor relationship, the investor and founder relationship should be that of a very high trust. And this is a trust business. This is a relationship business. So even if you're not raising money, don't lose the relationship. If somebody is saying no to you, don't lose the relationship. Always keep the relationship open because a no is a maybe and a maybe is a yes. And that's the optionality you want to keep. So always define clear steps. at times it's also important for you to ask the investor, even before the meeting, what would you like to hear this time? It's a very good strategy, and a lot of founders do it. Even when you're not raising, keep the investors you would like to raise from updated on a monthly basis by sending them a TLDR, too long, don't read mail with key highlights. What are you excited about? What are you grappling with? Do informal coffee chats. And if you're in a market where you're getting a lot of interest, it's perfectly okay for you to clearly tell the investor by when do you expect to close the round, what are the interests you have, how much of the bite in the round is left, and offer a deadline to the investor in a very nice, genuine manner without showing any attitude and saying that, hey, we really need to close the round by XYZ date. We are already oversubscribed or 80% committed, and I would really appreciate it if you could get back before that.
No, I think I completely agree, right? I mean, that investor and founder trust is, I think, paramount, right? And I think really like the point where you said that maybe is a yes, and a no is also a maybe, right? So it's important to keep that long-term relationship, keep them involved. And then a lot of times founders would be apprehensive about sharing, some updates about external investors, right? But I feel it's completely fine to keep them in the loop, keep them updated, because you never know when, an investor might be interested in coming back and investing in the business.
And at times the round gets constructed very fast when you say that, hey, I'm talking to XYZ VC. They're also diligencing us. At times 2 VCs will just exchange the thesis. And one VC might not be sure about one parts of the business, which the other VC might be able to convince them, thereby closing the round faster.
Correct. And I think we're almost we've covered all the questions, but one question that I dealt with, and a lot of other founders deal with as well, is dealing with a no, right? So what if you're not able to raise money, right? You put your life and soul into it, you've really built, you've pitched to 100 investors, you've got no's from all 100, right? How do you deal with it mentally, emotionally, and from a business point of view as well?
I think you have to have a growth mindset. You have to, after every call, every meeting with investors, prospects, you have to soul search. You have to understand what happened in the meeting. In most meetings, the unsaid is more important than the said. What was the body language of the investor? What questions could you not answer? What are the points where you could not convince? And that has to keep going back into your pitch, making it better so that you become bulletproof at some time. You have to reevaluate your pitching strategy. Are you pitching in a bad market? Are you pitching to the wrong investors? Are you going in cold versus a warm introduction? And breakfast is the feedback is the breakfast of champions, I always say. And it is very, very important to not let no just means it's a no for now. No does not mean it's a no for lifetime. No just means that maybe I'm not the right investor for you. No just means that, hey, maybe it's not the right stage. So understand the reason. Continuously keep focusing on the customer. Continuously focus on building the business, building the team. And at times, if the investor has liked you, you can always ask them for recommendations to other investors, introductions to other investors. And a lot of people who like the pitch, but for some reason are not investing, are perfectly okay with providing you access to their network and doing you a paid forward.
No, I think in that aspect, I've seen that people are incredibly helpful, right? So even if they're a no, right, they can still recommend you to a network. They might recommend you to somebody who might be more relevant for you at the current stage or in the sector that you're building, right? So it's important, as you said, no, maybe for now, and may turn into a yes in the future, right? So take that feedback constructively, still have that relationship with them, keep building that trust, keep them in the loop, use their network to reach out to more people, and just, I think, build on that feedback, focus on your customer, keep building, and eventually, then come back.
And, if you're facing a lot of rejections, focus on cutting costs, extending your runway so that you don't run out of cash. Focus on identifying other sources of capital. It could be a bank overdraft. It could be invoice discounting. It could be raising money from your customers. It could be raising money from friends and family.
Yeah.
It could be selling a part of your business.
Yeah. Yeah.
It could be changing your business model.
Yeah.
So don't let investors be the only source of
Yeah.
fund.
Yeah.
And like you have venture capital, you also have venture debt.
Yeah.
Venture debt, you have revenue-based financing.
Yeah.
You have grants from government.
Yeah.
You have awards which come with cash grants.
Yeah.
So there are many opportunities to raise money,
Yeah.
both dilutive and non-dilutive.
Yeah.
So don't let VC be the only source of raising money.
Interesting. And I think completely agree. Like when we were building Zoe as well, right? So for the first 2 years, I think our revenues were 30 lakh and then 60 lakh, but we were kind of burning money. And, there were some issues with our business model. So we got a lot of feedback from investors. We were not able to raise, right? Third year, we decided, okay, let's take a bank loan. We took a loan of 20 lakh rupees. And the third, we changed the business model a little. Grew the business from 60 lakh a year to 10 crore a year.
Wow.
Right. And that's when we realized actually we don't need to raise money to now scale the business, and it went down to become very profitable in large business. Right. So I think very interesting that you don't need to be married to just diluting equity to raise capital, right? You could have multiple sources of raising capital, right? And it's important to understand which is right for you, and and then be very frugal and with that usage as well.
Excellent, Karan. I think it's been amazing thinking through some of this stuff together and talking about how can early stage founders raise capital and grow their business.
No, I think it was a super relevant session, Apurv. Thank you so much. We are very excited to release all of this to our Founder Academy cohort, and help early stage companies really grow 0 to 1 and grow 1 to 100, right? Like I keep talking to you, and you're building this entire ecosystem where you're not only helping companies in an early stage, but also then helping them with growth capital, and eventually you're building this funnel which leads them to an IPO, right? So like if India has 110 unicorns today, and in the next 8 to 10 years, as India transitions to a $5 trillion economy and a $10 trillion economy, if the number of unicorns become from 110 to 1000, and if Accelerate can play a small role, I think our lives, would be fulfilled.
Amazing. I'm sure we will. Thank you, Karan.
Apurv, thank you so much for this enthralling conversation. Very relevant. I've been a founder for 8 years. I've started 2 companies, been a part of the ecosystem for so long. I still got so much learning out of it, and very excited for other founders to kind of access this as well, right? Before we end today's chat, I would love to also share a little bit about our partners at Accelerate. One of our partners, which is a company called Business on Bot. So you and I are also investors in Business on Bot, and Business on Bot is one of India's largest conversational commerce companies for D2C brands. So they help D2C brands with acquiring more customers, building loyalty, building retention, and reducing their customer acquisition costs through conversation platforms like WhatsApp, right? So would love to understand from you, like, what is your view on conversational commerce in the country? And this could be across platforms. Maybe it's WhatsApp today, maybe it becomes a Telegram tomorrow, maybe it becomes an Instagram DM, right? Or maybe some other platform comes up, right? But generally, consumer brands would be here to stay. They would need a platform to converse with their customers. And when there are businesses which are building this technology or stack, which is like conversation commerce for brands to customers, what is your view? How can D2C brands leverage it more, and where do you see this industry going?
So I think this whole conversational commerce started in China and became very big, and a lot of successful Chinese companies were built around conversational commerce, where you could, while we were talking to each other on a messaging platform, and you said, hey, let's go to Goa. And I said, yeah, why don't we finalize dates? You told me the date, I accepted it, our calendar got booked. I messaged, let's look at flight options. Flight options started. So in China, we started seeing the whole transaction from inspiration to the discussion, to discovery of options, to the payments, to the closure, to the invoice being generated, and loyalty being done. I think India is getting to that stage. Think about commerce. It started from barter. It moved to stores. It moved to modern trade. It moved to e-commerce. It moved to branded sites, brand sites. It moved to social media. conversational commerce is the latest evolution in commerce. It's not going to be either or. Most brands will become omni-channel as they grow.
Yeah.
And conversational commerce is going to be a very important part. Many consumers today don't like, discussing or speaking to someone or actually stepping out of their house. If a messaging platform can solve for that need, which Business on Bots does.
Yeah.
Business on Bots today is used by more than 600 brands,
Yeah.
loyal customers, founders who are really benefiting from the low cost of scaling,
Yeah.
managing conversations.
Yeah.
It's going to be incredible for the ecosystem.
Yeah, yeah. And I also feel that it's a very interesting point that you mentioned that, conversation commerce is not just for D2C brands, right? When you look at offline businesses, large retail businesses, right? So if you have a store where, people can just scan a QR code, start conversing with you on one platform, and from there essentially to get more discounts, be loyal customer, explore more products. So it's also very relevant for offline businesses as well, right? So this is not going to be like a D2C only phenomena, right? And I think it will be very interesting how this plays out when brands start looking at the entire journey, right? Not just selling or pushing products through conversational commerce, but actually doing discovery, doing loyalty, doing retention, giving money can't buy experiences. When all of that ties in together, right? I think, and which I think Business Bot has built that whole stack.
I think Mohit and his team at Business and Bots have built an incredible platform, and the really, really exceptional growth is a testimony to the fact that founders are seeing fabulous benefit in using conversational commerce and Business and Bots to grow their customer base, engage with them. Upsell, cross-sell is such an important use case.
And, as part of our Accelerate cohort, a lot of our founders also get credits for Business on Bot, which they can use, to grow their business as well. So super excited for this partnership. And again, Apurva, thank you so much, for taking the time out. I know you've had a very busy, very hectic, last, I think 15 years, right? I know your schedules and it's absolutely crazy. Like you're working till 3, 4, you're working out in the morning, you're doing like multiple events in a day, you're meeting 4, 5 founders in a day, right? And I think this one thing that I've loved about our relationship over the last 10 years is that whenever I've reached out to you for any help, right? So you were not an investor in my company, right? And we are not related, right? But whenever I reached out to you for any help, you opened doors for me. Like whether it was about finding a job, whether it was about connecting with the right investors for my business, whether it's about learning about angel investing, right? And I think that's how the startup community in India is evolving, right? It's incredibly supportive. It's incredibly, we all want to help each other grow and pay it forward, right? And I think kudos to leaders like you, for stepping up and, building that entire culture.
It's been incredible knowing you, Karan, watching your journey, learning from you. And I think the best is yet to come. As they say, it's day zero.
Yeah. Amazing. It's day zero for us as well here at Accelerate. Thank you so much for joining in. We'll be back with another episode next week. And you can visit our website. You can apply to our cohort. You can listen to our podcast on YouTube, on Instagram, on LinkedIn, on Twitter, now X, or any other platform. And we're super excited to be a part of your day zero journey. Thank you.